In today's video, we're going to try to find the balance between risk and reward and identify two ETFs that might need a home in our portfolios. Let's think of a two-fund portfolio as a pair of sturdy wheels on a bicycle. Each wheel representing an exchange-traded fund that's been carefully chosen to support your entire investment journey. Just like a bicycle needs both wheels to move forward smoothly, your portfolio can rely on these two ETFs to provide the balance, stability, and propel you towards your financial goals. So let's do some research together and find the top performing growth ETF and income ETF. For our research, we're going to use ETF.com and their screening tool. And before we even start our deep dive, you can see that there's 3,212 different ETFs to choose from, so we're going to need to whittle this down a bit. Let's start by selecting US-based equities that are grade A. And just like that, we've reduced the number down to 290 ETFs. Let's add some additional criteria around total returns because we want some solid performers. So we're going to add a minimum total return of 10% for the 1 year, 3 year, 5 year, and 10-year total return, which if you're new to investing, is any share price appreciation plus dividends being reinvested. And that leaves us with 39 ETFs to review, but I think we need to drill down a little bit further. Because we're looking to invest and grow our portfolios, we want to look for ETFs that have reasonable expense ratios. So let's find ETFs with expense ratios less than 0.5%. And with that sorting, we're down to 7 different ETFs. 2 Vanguard ETFs, 2 Schwab ETFs, 2 State Street Global Advisors, and 1 ETF managed by BlackRock. Now, before we go any further with our comparison, it's important to note that IVV and SPLG have 100% of their holdings in VOO. VOO, the Vanguard S&P 500 ETF, is a full replication of the S&P 500 index. IVV, managed by BlackRock, and SPLG, managed by State Street Global Advisors, both use a representative sampling technique for stock selection. Let's take a look at what that means before we move on. As per the evidenceinvestor.com, representative samplers select a subset of securities from the index using characteristics such as dividends or earnings yields other than index weights while maintaining the goal of matching index returns. All things considered, SPLG has a slightly lower expense ratio at 0.02%, but significantly less assets under management at $19.99 billion as compared to VOO's $335 billion and IVV's $353 billion. With all that said, let's use total return to see which of these ETFs comes out on top. And Seeking Alpha shows us that while they are incredibly close, VOO is the winner here, with a total return in the last 10 years of 213.71%. As we continue on our path to find the best growth ETF, we're going to knock out both IVV and SPLG and look more closely at the remaining 5 ETFs. Let's start with the 2 ETFs that are being managed by Schwab. SCHX, which is the Schwab US Large Cap ETF, tracks the performance of the Dow Jones US Large Cap Total Stock Market Index. It uses a full replication technique and has an expense ratio of 0.03%. Then we have the Schwab US Large Cap Growth ETF, which has a 0.04% expense ratio, and it also uses a full replication technique but tracks the performance of the Dow Jones US Large Cap Growth Total Stock Market Index. When looking at the overlap between these two ETFs, we find that 100% of SCHG's 243 holdings are also found in SCHX's, which is the much larger ETF with a total of 751 holdings. Next, we have VV, the Vanguard Large Cap Index Fund ETF, which tracks the performance of the CRSP US Large Cap Index, also using a full replication technique. It has a 0.04% expense ratio, and 84% of its holdings are also found in VOO. Next, we have SPTM, the SPDR Portfolio S&P 1500 Composite Stock Market ETF. It contains the largest number of holdings at 1,527, but has the smallest assets under management at $6.7 billion, and has an expense ratio of 0.03%. When reviewing total return for the remaining 5 ETFs, we find that SCHG has the greatest 10-year total return at 296.75%. When looking at the diversification of SCHD, we can see that technology makes up the greatest portion at 44.96%, followed by healthcare at 13.32% and communication at 13%. And here you can see the top 10 holdings of SCHG, with Apple, Microsoft, and Amazon making up the top 3. But I'm not finished yet, because I promised you a 2-fund portfolio, and SCHG represents the growth wheel on our bicycle. So we now have to look at those ETFs that can provide us the income we're looking for. So let's head back to ETF.com and use their screener again. We'll select US-based, Grade A, equities, which brings us down to 290 ETFs. And because we're looking for income, let's add a minimum dividend yield of 2%, which brings us down to 84 ETFs. Now, as we did for the growth ETFs, let's add in a 10% total return for the 1-year, 3-year, 5-year, and 10-year periods of time. And just like that, we're down to 3 ETFs: the Schwab Fundamental US Large Company Index ETF, the Invesco S&P 500 Revenue ETF, and the Invesco S&P 100 Equal Weight ETF. Let's jump back over to Seeking Alpha and dive in a little bit further on these 3. The first thing that jumps out to me is the higher expense ratios for all 3. FNDX with a 0.25%, RWL at 0.39%, and EQWL at 0.25 as well, which does have an impact on the overall value of your investments over time. When we review the 10-year total return, EQWL comes out on top with 195.43%. Per Seeking Alpha, the dividend grades are strongest overall with EQWL as well, but it is important to note that the Invesco S&P 100 Equal Weight ETF is the smallest of the ETFs, with only $324 million in assets under management, whereas RWL has $2.1 billion and FNDX is at $12 billion. EQWL has the highest yield in the trailing 12 months of the 3 at 1.97% and the highest 5-year dividend growth rate at 12.38%, but it only has 4 years of dividend growth. Assuming a $10,000 initial investment, dividends being reinvested, and without adding any additional capital, at the end of 10 years, you'd receive the most dividend income from EQWL with $518 in 2022. What do you think of these 3 options? I'm just inclined to add SCHD to the mix to see how it stacks up. In terms of assets under management, SCHD is the largest of these 4 ETFs with $49 billion and has the lowest expense ratio at 0.06%, which significantly lowers the cost of investing. The total return is just under the Invesco S&P 100 Equal Weight ETF, and Seeking Alpha gives it the strongest dividend grade of the 4 at an A+. With the highest dividend yield in the trailing 12 months of 3.53%, SCHD also has the strongest 5-year dividend growth rate at 13.92% and the most years of consecutive dividend growth at 11. So what do you all think? Let's go back to Portfolio Visualizer to see what SCHG and SCHD look like together after 10 years. Now, we started this video looking for ETFs that also offered growth, and we landed on SCHG. So if we were to combine SCHG and SCHD, what might that portfolio look like after 10 years? Same scenario, $10,000 invested, dividends reinvested, no additional contributions. SCHG, all on its own, would have a final balance of $41,793. SCHD, all on its own, would have a final balance of $40,315. And if we did 50-50 and combined the 2, we'd have a final balance of $41,054. In 2022, you would have received $229 from SCHG, $1,338 from SCHD, and if you split the 2 equally, you'd see $784 in dividend income. Which brings me to the bottom line. Are you riding a 2-wheeled bicycle with SCHG and SCHD, or some other combination? Or are you jumping on an SCHD unicycle? Let me know in the comments below what you think and what your favorite mix of ETFs to individual stocks is. And until next week, go and take a peek at this video next. Am I saying this right? Oh my heavens.